All right, everyone. I think we'll go ahead and get started. So I'm Rebecca Mears. I work with VIN Foundation. I'm a member of the student debt education team. Really excited to be here with you tonight for our interns and residents webinar. I'm just going to do a couple of quick housekeeping things and everything, and then we'll get it turned over to Dr. Bartels, and he's going to share with us everything you need to know about your student loans as an intern and resident and starting repayment. So we've been testing our chat. That's been working pretty well, which is awesome. Thank you all for that. We do try to keep the chat to any like technical issues throughout the webinar, and then use the Q&A. So you'll see that Q&A button down at the bottom of your screen, and then use that Q&A for any of the actual questions you have about the content, what's been going on, or any of your other situations. The reason we do that is you can't upvote those questions, and so that helps us to figure out which are the most popular questions that a lot of people are concerned about. We can make sure that we get those answered sooner rather than later. We will answer all your questions tonight. We'll have some Q&A time at the end as well. So if you're seeing that we're not getting to that question throughout the conversation, we will get to that towards the end. So again, just technical issues in the chat, and then try and keep Q&A questions to that Q&A section. You can ask questions in that Q&A anonymously as well, so that's helpful there. We will be recording tonight's session, and that will be sent out with some other helpful information via email to everyone who registered. If you did not register, let us know. We can get you added to that list if so. And then I also wanted to introduce Jordan Bachia from VIN Foundation. She'll be in the background helping out as well. And then I think you might have seen some of our emails and things. We'll be giving out a couple of VIN Foundation Yeti mugs at random tonight. So you must be present to win those. So stick around with us. And I hope that we're going to have a great session. It's usually a really interesting topic. And I'm going to kick it over to Dr. Bartels.
Thank you, Rebecca. And I wish I had my Yeti mug in front of me. I don't have it right now. It's something like, I know. All right, cool.
I don't know if I can get my Zoom back.
They're really nice. So, all right, great. Well, thanks everyone for joining, and thank you to everyone who submitted questions in their registration, as well as the student debt and income signalment form. I've been kind of going through that yesterday and today, and looking to see what I can find. And of course, that makes me change around the presentations, yeah, as I'm sure some of you are accustomed to that have been doing these types of presentations on various topics in the past. When you guys ask me questions, I always want to figure out a way to rework them and work them into the presentation and make sure that I'm covering that topic adequately. So I've got a ton of content in here, really ambitious goals. If we don't get to everything tonight, you guys will get a link to this presentation as well as the recording, so you can click through any of the material that we might not be able to get to, or if you want to just review it. Again, everybody that registered will have access to the recording afterwards, as well as the presentation slides. I do this on Prezi, so it lives online, and you can click through that at your leisure after the session as well. But I learned a ton from those questions that you guys submitted. I did pepper a lot of those in throughout the presentation. A lot of it has to do with, just the changing nature of the student loan repayment landscape. It's been kind of nuts the last few years, and it's going to get even nuttier at the end of the summer. So we're going to cover that, because interest and payments are going to be a thing again. We've gotten more than a 3-year reprieve from that, but unfortunately that is coming to an end. We found that out when when Congress and the president signed that debt deal. One of the weird provisions in raising the debt ceiling was that there will be no more pandemic forbearance extensions on student loans. So not really sure how that's related, but that officially is going to put an end to the what has been known as the pandemic forbearance benefits. So let's dive in, and after looking at some of the submissions and some of your student aid data files, and we're going to go through this, what I call student loan physical exam. I mean, just the random ones that I picked are eye-opening, right? I mean, just the concepts for illustrating the things that I think you should be doing, things that a lot of you probably haven't done yet, but think you maybe have done. So these are things that we're really going to want to get ironed out, either before you start your internship, before you head to your residency, before it gets too crazy with summer and fall, and then all of a sudden repayment and interest starts. That's not when you want to scramble to figure this out, right? Some of this stuff is time sensitive, and some of these things you want to actually dedicate some time to ironing out before this, let's call it the scramble, it's going to be kind of an unmitigated circus when payment starts back up, because I don't think anybody's prepared for what that's going to entail. So you don't want to be part of that circus show. If you can avoid it, doing this ahead of time will help you avoid some of the frustration with trying to get things ironed out at the last minute. All right, so, like any complicated case, I mean, I know our brains are wired for veterinary medicine, and many of you are already kind of into your training. You may not have the financial training to wade through all of your student loans in details, but conceptually, it's the same as the patients that we treat, right? We're going to collect some information. We're going to measure some vitals. We're going to do some CBCs, chemistries, the advanced diagnostics to get the data that we need to treat our patients appropriately. Same thing with our student loans, except in this case, you're the patient, right? It's your student loans. And depending on your path to and through veterinary school and your family and financial circumstances, all of that is going to play a role. Is going to be a data point in the measuring that we do that will help to lead us to what the best repayment strategy is. And that's probably the most common question you guys will all ask is like, what's my best strategy given all of the changes or what my circumstances are? And that's exactly what we're going to try to cover tonight, but also try to give you the tools to be able to adjust or identify those for your specific circumstances, particularly as they change over time. So we're going to do a physical exam and diagnostics. We're going to look at some treatment plans based on the best available data that we have so far. We're going to talk about side effects because there's lots of side effects to student loan repayment, no matter how you choose to tackle it. And then prognosis, as well as finish up with some wellness items after. Before I do that, I do have a poll here that I'm going to launch now that most of you have probably gotten into the room and joined. I kind of wanted to take a temperature to see who's here. You guys are all Zoom pros. Just gives a few more seconds to answer. All right. So here's what you guys are telling me. Great. So either headed into an internship or residency or already in one. That's great. Some students here too, which is also good. But we're going to really focus more on aspects of repayment. And those of you that are going to be facing repayment once the pandemic forbearance benefits end here. All right. Stop sharing that. Cool. So why do you want to worry about this now, right? I know you guys are all probably busy, scrambling, tearing your hair out, as you're starting your new programs or you're starting the, second, third year of that program, because most of us don't have a time machine. But thankfully, there has been sort of a pseudo student loan time machine with all of the benefits and changes that have been floating around. There has never been a better opportunity to undo some of the things that you may not have done correctly with your student loans since you've graduated. So that's the good news, right? But you want to take care of that stuff sooner rather than later. And for certain benefits, you have to do it, particularly by the end of this year. Otherwise, you're going to miss the boat, right? So the time machine is only going to be available for a short amount of time. But here's some of the prior comments we've had from residents that have gone on to do specialties that, again, wish they would have had this information and acted on it way sooner, right? Because it can save you tons of time, money, and stress during repayment the sooner that you take care of this and put your loans on the right pathway. So I use this as an example of a prior comment that somebody submitted who's now a specialist, that they were annoyed that they borrowed $180,000 for school, and then after their internship and residency, their loan balance ballooned to $270,000 as they're finally starting their real job with a real salary. And this is a goof, right? This is kind of not acting on your loans soon enough and allowing them to kind of just do what they do during an internship and residency by doing kind of the conventional wisdom, that deferment that we want you to avoid at all costs. right? That's how your interest can balloon like that. It gets added to your principal. You end up paying more back than you otherwise would have to, right? So this is entirely avoidable. And even with some of the newer benefits that are going to be coming online soon, unpaid interest and your loan balance growing will hopefully be a thing of the past in short order here. Some other issues that come up, having some public service loan forgiveness credit, depending on your advanced training experience, many of you should be eligible to receive some public service loan forgiveness credit. A lot of you asked about that. If you can document that credit, that's great. What you choose to do after that training, right, will determine largely whether or not you're going to reach public service loan forgiveness, right? So if you stick maybe in academia, or if that you have an opportunity to maybe satisfy that public service loan forgiveness, certain specialties lend themselves more to that nonprofit sector, like lab animal vets, and some of the other ones that kind of lead you into academia. Those are going to be public service loan forgiveness opportunities, right? So making sure that you're documenting and trying to get that time while you're doing your training will make it so your loans are forgiven sooner rather than later, right? So that's going to be something we're going to talk about as well. You don't want to wait until you finish that residency to really make these decisions, because again, you're not going to be able to go back and correct some of these things in certain cases, in most cases actually, but you do have this pseudo beneficial time machine available now. And because repayment and interest is going to start accruing again August 30th at the latest, right? So that's what the debt ceiling legislation said, that no more than 60 days after June 30th is the latest that this pandemic forbearance can last. It's still loosely tied to what the Supreme Court's going to decide on the special cancellation benefits. So if they come out tomorrow and issue a decision on that, then the pause will end actually a little bit sooner, right? So, but at the latest, the pause will end on August 30th, 2023. All right. So everything that's got kind of this pink salmon colored box and is going to indicate an area where there's some new changes or changes that will be implemented soon that you're going to want to be aware of, that will probably impact your repayment strategy in the short and long term. But with all these changes, I know some of it's stressful, but it also presents some opportunities for new repayment strategies that are going to save a lot of us a lot of money. So that's exciting. I'm going to give you a little bit of background on myself and why I'm so passionate about this, but I'm a married 2-vet household, so what I affectionately refer to as the double vet, double debt household. My wife is actually a specialist, right? So we got to see and experience all of the things you should and should not do with your student loans during some of her advanced training. So we have some unique experience with that, but also Beck and I are knee deep in the student debt message board area on VIN and VIN Foundation, helping our colleagues, whether they're students, recent grads, interns, residents, specialists, and beyond. So, over the last several years, have acquired a boatload of experience on how best to handle your student loans during whatever your career path is after your training. So feel free to, and I'll highlight how you can take advantage of that student debt message board area and show you what that looks like as well. But that's where a lot of this information comes from. It's helping to create and wade through our colleagues' student debt information and helping them craft a repayment strategy for thousands of those cases, if you will. But we're also a case ourselves, right? So my wife and I combined, we have more than $400,000 of student debt, almost all of it from veterinary school. If you do nothing, right, and this is going to be something we haven't had to talk about this for a few years, but those of you that have yet to experience repayment, if you haven't done anything with your student loans, they are going to roll into a standard 10-year plan payment, right? So that's a time-driven plan that's based on the amount that you borrowed, your principal balance, the interest rate, and the minimum monthly payment that would be required to extinguish that balance in a 10-year time frame or 120 monthly payments, right? So if you've got $200,000 of student loans and you didn't choose a repayment plan, you're going to get a statement, a bill for a payment in September that's going to be more than $2,000 a month, right? So that's not going to be very conducive to a intern or resident salary. So you're going to want to choose something different before we get to that time frame. So make sure that if it's nothing else, you're confirming what your repayment plan is currently. And if you haven't chosen one, you're going to want to choose one that's going to result in a payment that's much lower than a standard 10-year plan payment in most cases. Right. So, and that's where we get into some of these income driven repayment options. They are excellent. Now, they are super confusing, but they're super beneficial, particularly when we're talking about internships, residencies that are generally low paid compared to what our colleagues in private practice are earning out there, but they can help you earn forgiveness credit in case you need it, but also decrease the cost of the interest that will accrue during that particular advanced training experience. So my wife and I started using a plan called income-based repayment. We were eligible for the older one. There's also a newer version of IBR that we'll talk about, but we're not eligible for that. You're either eligible for the old one or the new one. Can't be in both. And that plan was not, it was good, but it wasn't great. And the newer plans were much better, right? So we've since switched to a newer version called Revised Pay As You Earn. This one's going to get a lot of focus, particularly with the proposed changes that are coming online likely next year, because they result in a lower monthly payment, but they also come with a really beneficial unpaid interest subsidy. So when your payments are really low because your income is really low, the government will cover a lot of that interest for you, right? So it'll help contain those costs. So that example that I shared where that person was frustrated that their balance ballooned by nearly $100,000, that won't happen, right? But it requires you to choose the right repayment plan and do the right things to make sure that that doesn't happen. So Repay is great for that, particularly these changes that are going to be coming online hopefully in 2024. Now, all of us that have been able to experience this pandemic forbearance benefit, which was even more beneficial, right? So no interest, no payments. For those of us that have been working towards forgiveness, we also get forgiveness credit for that. So it's kind of accelerated our likelihood to reach student loan forgiveness. So that's all been super beneficial. But again, it's kind of coming to an end. And the way these income-driven plans work is you make payments based on your income for a specified period of time. And if you have a balance remaining, when you reach the maximum repayment period, either 20 or 25 years, depending on the plan, and we'll go into all those details in a little bit here. If you have a balance remaining at that end of that time frame, it will be forgiven and it can be treated as taxable income. So the trick is knowing whether or not you're likely to reach forgiveness based on your best guess of what your income and financial circumstances are going to look like in the short and long term, right? And that's where we get into the student debt center tools like the My Student Loans tool and the student loan repayment simulator that helps us take the information available to us now and then project it long term to give us a little bit more certainty around that likelihood that we'll reach forgiveness, right? So it's not really about whether or not you can pay your student debt back or you want to or you can't or whatever the case is. It's really just a math exercise, right? And what's the likelihood that you're going to reach forgiveness, right? So my wife and I have $400,000 of student debt. We've been doing this now for 11 years or so. Repay has a maximum repayment period of 25 years. So we have 14 years before we hit forgiveness. If we wanted to pay that $400,000 back in the next 14 years, we'd have to pay more than $3,500 a month to do that. Right now, our income will not require us to pay anything near that amount, right? So it doesn't make sense for us to pay or try to eliminate the debt or pay more than our income requires because it's going to get forgiven anyway, right? So this is the conundrum that people often find themselves in and twist themselves into a bunch of emotional knots about whether or not forgiveness is a good thing or a bad thing. It's just a math thing, right? If your income requires you to pay less than you would otherwise have to pay to extinguish the balance, then pay less, right? Because you're going to have more flexibility, you'll have more cash flow to do all of the other things that you also told me you wanted to do, like buy property, buy a home, start a practice, start a family, all of those things that you guys put into your primary concerns in your registration form. All of those things open up if you can use an income-driven plan or you see that there's a significant difference between what an income-driven plan requires you to pay and what it might require you to pay to extinguish that balance. right? But that also requires us to plan for forgiveness. So we do that as well, right? So we're not making any payments towards our student loans right now because we don't have to, right? But we are working on our forgiveness planning fund, right? A lot of you ask questions about the quote tax bomb, right? This is what it looks like to save for the tax bomb, right? So we have a separate dedicated fund that we contribute to on a regular basis that's designed to pay that tax if we reach forgiveness and we have to pay tax on what's forgiven. Right now, I don't want to get too much into the weeds here. We have a blog post on vinfoundation.org that goes into detail on how you can plan for forgiveness, because a lot of you that are going into advanced education, that's way putting the cart before the horse, right? What I want you to be able to do is just know your debt to income ratio, know how to use the student debt center tools, whether or not it's likely that you'll hit forgiveness, but you're not going to want to worry about saving for forgiveness until you actually are done with your training and you have some disposable income, right? Most of you, I just want you to focus on getting through that advanced training without taking on any more debt, right? So don't worry too much about the forgiveness savings plan now, unless you've got some room in your budget to save. But even then, there's probably better things you could be doing with that flexibility you have. Wait until you finish that training and you're actually earning and have enough surplus in your budget to worry about that forgiveness plan in more detail. So how do we start this physical exam, right? So we're going to head over to studentaid.gov. Most of you, and if this isn't if this is the first time you've seen this, I'll just make sure that you know how to get to these places to get this information. But everything kind of works off of your federal student aid data file, right? So if you're using FAFSA or you borrowed U.S. federal student loans, then you're going to be able to log into this studentaid.gov account, right? So there's a login here. And I'm going to try to log in. I may not. I have to do my email there really quick, see how fast they send me that email. I don't have my phone in front of me for like the first time ever, so I can't do the text message. And they added this secondary security recently, which is a good thing. Let's see if give it just a second here. Oh, it looks like I'm not going to be able to get that. I'll have to come back to that when I get that code. All right, so but when you get into your student aid account, you're looking for a My Student Aid download, right? So it's going to be your complete history of your federal student loan borrowing from undergrad, from graduate school, from veterinary school, whatever you use federal student loans for. Here we go. Got it now. All right, and this by itself is usually kind of a scary exercise, right? So it's kind of walking you through the taking the head out of the sand. I know these numbers can be scary, but they're just numbers on paper, right? This has been the investment you've made in yourself to get through and achieve your veterinary career goals, right? So here's my share of the household student loan balance. So I've got principal, I've got some interest here. I can see who my loan servicer is, but this isn't enough information for me to make any decision. So I have to hit this view details button. And this is what takes me to the next page, right? And that's the link I'm looking for. Download my aid data, right? If I click on that, it's going to save this ugly looking TXT file, save that to your computer somewhere, right? Because we're going to take you over to the VIN Foundation My Student Loans tool so you can upload that and actually make some sense. Start doing some diagnostics on your student loan information so you know what to do next, what you can do next, what you should do next. Those are the things that we're going to tackle using that information. All right, so when you're looking at that information, right, we're looking for our loan types, right? There's a lot of different loan types depending on when you started veterinary school and the types of loans that you accepted, how much you have. Obviously, the interest rates are going to be different for every loan depending on when you went to school. Either repayment plan that you're currently using, if you've already selected one, as well as the repayment plans that you're eligible to use, right? We're going to spend a lot of time deciphering between which ones can I use versus which one should I use, right? I see a lot of a disconnect there sometimes. And even in one of the examples I have, somebody said in their Sigmund form that they're using IBR, but it's actually showing pay as you earn, right? And those are different repayment plans. I know it's kind of maybe seems like a distinction without a difference, but they're very different, right? And you're going to want to know what repayment plans you're using and which ones you're eligible for, so you make sure that you're using the right one. If you've got a minimum monthly payment, it'll show that in there. And then obviously your terms and conditions, that really applies more to loans outside of the federal system. Everybody that has federal student loans has the same terms and conditions based on the loan types you have. But if you've got private loans, which a lot of you indicated you did have, those are going to vary based on the private lender that you took those loans from. So you're going to want to pull up those terms and conditions and look and see what the repayment terms are there, particularly during advanced training. Right? Some of them don't have very robust deferment or postponement provisions. Right? So you're going to really want to investigate, what are those loans going to require me to pay, even if I don't have very much income during my advanced training. Right here, let's check out an example. So I've got several that I pulled from your submission tonight, and I anonymized those to use to illustrate some of these concepts. So I'm going to take you over to this VIN Foundation My Student Loans tool, so you can see how we use this and how we hope that you're going to use it too. So the My Student Loans tool is where you want to start, right? It requires that exe file that we just went and got from studentaid.gov, right? So you've got these 3 boxes here, right? You've graduated. You're going to upload your student aid data file. Right now, this is one that this is kind of a this is a unique one, right? One not I don't typically expect to find, except when we do these kinds of sessions, right? And we ask you to submit your homework ahead of time, and this really gives us some insight into the various circumstances that are floating around out there. But this is a person who graduated from veterinary school in 2012 and is now finding their way into a residency, right? So they had a bunch of veterinary practice career time before they went into their residency. So they have a really good collection of some of the older loans and the differences in the way that we used to finance education in here, but also have some opportunity to take advantage of some of the benefits that are in place now. And that's what this alert is meant to illustrate, right? So if we find that you have some of these older loans in your student aid data file, we're going to tell you, hey, this is something you want to pay close attention to, because you've got a unique opportunity here to act on this and make your overall loan portfolio behave a little bit better going forward. Right. So you'll see this pop up if you have these older loan types. They're called FFEL loan types. So we're going to get into that in just a second. But I wanted to just illustrate some of the reason why you want to grab that text file and upload it into the My Student Loans tool, even while we're meeting here tonight. Right. So I would encourage you to do that. Go to studentaid.gov, grab your text file, pop it into My Student Loans, and see what you're seeing. And if you have any questions about what you're seeing, this is a great opportunity to ask. All right. So this person graduated in 2012. They've got, now in their signalment form, they indicated they had more than $600,000 of student loans, right? But turns out they were double counting a lot of stuff. And maybe that has more to do with how we ask the questions, but when I see that, it's more of a relief, right? So this person actually has less debt than they indicated in their student debt and income signalment form, which is kind of a bonus, right? So principal, this is what you accrue interest on when interest is accruing. Unpaid interest, that's pretty unique to using an income-driven repayment plan, right? So interest doesn't always get added to the principal. This is one of these unique aspects of your federal student loans, and why you shouldn't treat them like other debt, or why you shouldn't be nearly as scared about your student loans as you should be about any other debt, right? You have this incredible opportunity to have the unpaid interest accrue separately from the principal, and this interest doesn't accrue any additional interest unless it gets added to the principal. Right, so the total owed is about 521 here. Average interest rate across all of the different loans. They've got 22 different loans in their portfolio. That's a lot, right? And sometimes I see that creates some analysis paralysis, right? So you see a lot of different loans, a lot of different interest rates. And I'm like, oh God, what do I do, right? The My Student Loans tool is kind of designed to treat it as if it is one loan, right? So we can give you what a weighted average interest rate is across that entire portfolio. We can see that they're going to accrue about $2,500 a month of interest on this principal. Right, another alert here, right? We detected that they've made a payment during the special pandemic forbearance benefit period, which started on March 13th of 2020. If anybody here has made a payment on their loans from March 13th, 2020 up till the end of the pandemic forbearance benefit, you can request a refund of those payments. Right? And for any of you that are doing some advanced training and not earning very much income, request a refund. Right? You can do better things with that money to make sure that you don't end up in, deeper debt because you can't make ends meet during your advanced training. Right? So if anybody has made a payment from March 13th, 2020 through the end of this pandemic forbearance benefit period, request a refund. Right? That's one of those time machine benefits. Right? You'll never get that opportunity again. I'm actually shocked that they let people do that. Right? But you have to request that directly from your loan servicer. We can see here that this person's loan servicer is AidVantage for the majority of their loans. Right? Now they have some of these older loans that they thought were private loans. They're technically still a federal loan, but they're held under a private lender, Navient in this case. Right? But these are still federal student loan types. Right? Now this person can consolidate these loans and should consolidate these loans, and they'll still maintain all of the forgiveness credit that they've already earned on these loans. And in fact, they'll probably earn more. Right? That's called the one-time forgiveness count adjustment. And we're going to talk about that just a little bit too. But this is a messy loan portfolio. I've got repayment plans and an older income-driven plan. I've got some loans in a newer income-driven plan. Right? I've got a monthly payment of 0, which is great. Right? But once the pandemic forbearance benefit ends, right, this monthly payment is going to be quite high once they document their income, because pay-as-you-earn generates a much lower payment than IBR 2009, and they can get these other loans, these FFEL loans into pay-as-you-earn if they consolidate them. Now, in the past, there was reason not to do that because consolidation would restart your forgiveness clock. But the special one-time forgiveness count adjustment that's available until the end of this year allows you to consolidate and preserve and even get some added forgiveness time across your new consolidation loan. Right? So this is just part of that physical exam findings, right? When I see stuff like this, it screams consolidate. Consolidate as fast as you can. Right? Now, then you'll have to reapply for pay-as-you-earn, right, to get all of those loans into the pay-as-you-earn repayment plan. Now, they may even want to consider using revised pay-as-you-earn for all of the loans instead of pay-as-you-earn. Now, this person's also married. They file separately to keep their loan payments low, but Repay technically doesn't allow that. Right? So the loans that are in pay-as-you-earn and IBR can't experience that separate income, that income separated from their spouse if they file separately. But if they use Repay, they would have to provide their spouse's income until the changes that are proposed to Repay take effect maybe next year, which we're also going to talk about. Right. So this is a really complicated one. This is also one that I would recommend that they ask for an analysis on the student debt message board folder, so we can walk through all of that with them and talk about all of these differences in detail. Right. So that's when you're logged in and you upload your file, you can see that it knows that I'm logged in here. You can log in with your VIN or VIN Foundation username and password. As long as you're a veterinarian, you don't have to be a VIN member to access this, but we just need you to have a username and password so we know you're a veterinarian. But you can click on the, yep, go ahead.
Couple of questions here in the Q&A about consolidation while we're on that topic.
Yeah.
One here says, won't the interest capitalize if we consolidate? Should we consolidate now at the beginning of residency?
Yeah, so the interest that is one of the side effects of consolidation, right? So that you will experience an unpaid interest capitalization. And I show this one, and that's why I would really encourage this person to post on the message board so we can document that in a little bit more detail. But here's what the student debt message boards look like. You can post anonymously in here. There are thousands of these in here, right? So Beck and I go through your signalment form submissions, and we analyze what we see in that My Student Loans tool, and we kind of give you all the pros and cons. But yes, if you consolidate these loans, this is going to get added to the principal. But preserving that forgiveness time and making all of these loans eligible for pay-as-you-earn and the future revised pay-as-you-earn is going to way outweigh even $128,000 being added to the principal. Right, that's going to significantly lower this person's monthly payment, and with the proposed changes to repay that we're going to go through, that's going to greatly reduce this interest that accrues going forward. Right, so again, you really want to take advantage of this. You only got about, you got less than 6 months to get this done now. Right, so we're kind of really bumping up against like get it going. Right, because it's really easy to put this on the back burner and I'll do it later and I'll do it later, and all of a sudden you're done with your residency. Right, so it's you really have to be kind of cognizant of the time, and this is, and we're talking tens if not hundreds of thousands of dollars of savings for this particular person just by taking advantage of that particular benefit. Right, so I'm requesting a refund, I'm consolidating these loans, I'm going to get them all into pay as you earn, or and then wait for that revised pay as you earn change to take effect. And that was just one example, right? That was just kind of one random one that I pulled out of there, right? So I just imagine multiply that by the number of you that are here and submitted those, and that's every one of those is a little bit different. So federal student loans, right? Direct loans, that's what you're looking for. Those federal family education loans, like we just demonstrated. Perkins loans, I see those still floating around, although they were discontinued in 2018, right? But they're still in a lot of your portfolios. Health profession student loans are a type of federal student loan. They won't show up in that student aid data file, but a lot of you know that you have them, right? So you can add them separately, right? So I've got another example we can go through there of a person who has health profession student loans that we can add to the My Student Loans tool and give you that overview of what it looks like if you were to include all of those loans together. Right, so this is a person who's got $220,000 of student loans. Right, let me look up my notes and see how much they have in health profession student loans. We've got 16,000 in health profession student loans. So I'm going to add those loans separately here, right? So I'm going to use this add loan feature. Health profession student loans. We only let you add those health profession student loans or loans for disadvantaged students because they're kind of these special loans that are federal, but they're administered at the school level. But they are eligible for consolidation, right? So the My Student Loans tool is really designed to be used for federal student loans, which is the lion's share of all veterinarian student loans, right? So we can add those special loan types here. It'll factor it into your overall portfolio, show you what that weighted average interest rate is. But when I see this, and I know you're heading into an internship or residency, this is another trigger for me where you should get those loans consolidated. Right, so get those loans consolidated so they can all be under the income-driven repayment umbrella. They can all be eligible for forgiveness if you need it. Right now, also kind of a bonus finding in this person's student loan portfolio. Right, they graduated from veterinary school. They're actually graduating in 2023. Right, or they just graduated. Right, but they must have had a bit of a U-turn in their career path because they've got some loans on their file here from 2012. Right, and I know from the loan amounts here that these are lower amounts. These are probably from undergrad. And they also have already been in repayment. Right, so this is another opportunity for this person to consolidate all of these loans, including that health profession student loans. And you'll actually get what looks to me to be about maybe 3 years, maybe 4 years of forgiveness qualifying payment added to their consolidation loan before they've even made any payments on their veterinary school loans. Forgiveness credit under this one-time forgiveness count adjustment. Right, so you have to do that physical exam of your student loans. Look to see how many loans are in here. Right, here's 15 loans. We've got some older loans, have some repayment time. There's this super beneficial one-time forgiveness count that lets us pretty much just transmit that repayment time and transform it into forgiveness qualifying time onto that consolidation loan. This person, though, has nearly no unpaid interest because they were in school during the pandemic forbearance benefit period. Right, so there's really no disadvantage to consolidating all of these loans for this person. So they should run to studentaid.gov and get that consolidation loan started as fast as they can. Right, so again, I mean, there was, dozens and dozens of those submissions, and these are just two that can really benefit from some of these term limited benefits and changes that are in place right now. So private student loans, unfortunately, are going to be anything that doesn't fall into this category. Right now, you can't find them on an annual credit report if you're confused in terms of which type of loan it is. Again, that student aid data file will help you identify them as a federal student loan. Right, and if they don't show up in there, if they're not a health profession student loan or a loans for disadvantaged student, then they're probably a private loan. Right, but they often have a bank or a lender's name associated with them, like Discover or Sally Mae or Bank of America, Wells Fargo, something like that, right? So those are going to be your true private loans. And unfortunately, there's no way to get private loans into the federal student loan system. Okay, so in general, you've got two primary methods for paying back your student loans. You've got a time-driven or an income-driven choice for your federal student loans. Now, time-driven is kind of the conventional repayment method we're all familiar with, right? You take your principal, your interest, the amount of time that you're allowed to pay it back, and that's what determines your minimum monthly payment, right? Those of you that want to pay your loans back as fast as possible is also a sort of time-driven strategy, right? But it does require you to calculate how fast you want to pay them back, right? Because then that's going to determine what the monthly payment's going to be. So it's technically a time-driven strategy, and you can do that with your federal student loans. I wouldn't recommend it, particularly during an internship or residency, but you do have that option. Private loans all have time-driven repayment plans. Now, these direct loans, your FFEL program loans, the health profession student loans that you can consolidate into a direct consolidation loan can be paid under these income-driven repayment plans, right? And again, they're super beneficial, particularly during this advanced training, and especially if you're not quite sure what specialty you're going to end up in, if you're going to end up in a specialty, where your career is going to take you. It's great at handling uncertainty, right? And reducing the cost and risk of your student loans during that career building phase where you're working your way to figure out where your place is going to be in veterinary medicine. So these are the laundry list of income driven plans that are currently available. Right? There's going to be some changes to that, as we've alluded to. Time-driven plans, the reason why they don't work very well is because the payment is based on your balance that you borrowed, and it's expensive to get a veterinary education, right? I see balances everywhere from $50,000 to more than $600,000, right? And those monthly payments under time-driven plans can be truly punishing, right? And more than many of you are even earning, right? So they're not even really, entertainable options while you're doing something like an internship or residency. And for some people, they're not even entertainable after that, right? It really depends on how much you borrowed for your education. This is just a sample of these 10-year repayment minimums at various levels of principal and interest rates, right? So these are some pretty staggering minimum monthly payments. Right now, your income is not going to require you to pay anything near that until it gets into the significantly high range, in which case, congratulations, right? But you don't want to find yourself paying these amounts until your income actually gets there, right? And that's one of the reasons why you don't want to refinance your federal student loans, right? Private refinances of federal student loans are really, really risky, and I would never recommend it, right? There was a period of time several years ago when the interest rates were comically low, where sometimes it made sense, and now it just doesn't. Right? You're never going to find anything with near the flexibility that your federal student loans come with, particularly with all the changes and benefits, if you take them out of the federal student loan system and put them into a private lender, right? It doesn't matter what kind of interest rate you can get. Even if you could get a private refinance of zero, they still would be less flexible, of zero interest rate. They would still be less flexible than your federal student loans. So don't do it, right? Please don't do it. Right? They just don't make any sense. Okay, so chat poll, kind of like we did with the where are you sitting and where are you located? Conceptual question: how much do you have to pay for your student loans each month? See a zero. That's true if your minimum is zero. Well, what if your minimum's not 0? And it's 0 right now, right? But what happens when the payments get turned back on? What do you have to pay on your student loans each month? Depends on your salary. It can if you use an income-driven plan. The interest, ooh, that's a good answer, but not. I wouldn't chase that rabbit, right? You have to pay the minimum, right? Exactly. So Yvette got it right. The minimum is what you have to pay, right? To keep your loans in good standing, you have to pay the minimum. Now, if your minimum is 0, then not making any payments will keep your loans in good standing, right? But if your minimum is something other than 0, then you have to at least pay that minimum monthly payment to keep your loans in good standing, right? So in this $200,000 at a 10-year repayment plan, the minimum monthly payment would be $2,195 a month. So you would have to pay the minimum in order to keep your loans current, right? But how much do you want your minimum to be, right? That's where we get into more of the other answers that you guys put in there, right? The discretionary income depends on your salary, 0 if you can get it, right? You can choose what your minimum is based on your income and tax filing status and family size using an income-driven repayment plan, which is much better alternative to letting your principal and interest rate determine what that minimum monthly payment should be. All right. So some of the changes that are coming, right? So this is the laundry list of plans that are in place now, but we want to make you aware that some of this is on the chopping block, right? So pay as you earn is on the chopping block, right? And now it used to be when we would do these sessions, we would encourage everybody to use pay as you earn because it was the most beneficial repayment strategy for veterinarians because it was the most flexible, had the shortest time to forgiveness. A lot of you were eligible for it, at least semi-recent grads, but it's likely going away. However, they're also going to improve revised pay as you earn, which is also going to make that probably the next most frequently used and most beneficial repayment strategy. Now, you don't have to freak out too much yet. They're going to phase out pay as you earn, but if you're currently using it, you can continue using it, right? You're grandfathered in, right? But you're going to have to be enrolled before those updates take effect, right? And that's probably going to be July 2024 or maybe sooner, right? So if it turns out that pay as you earn is still the most beneficial plan for you, you can stick with it as long as you're using it by the time these changes take effect, right? So you're going to want to keep one eye open on when that happens, right? But you also want to know which repayment plan is my file showing, right? So in this particular one, this is a new grad, hasn't chosen a repayment plan on their veterinary school loans yet, right? They're eligible for pay as you earn. So they may want to consider using it or putting it on their radar to make sure that they're using it before it gets phased out if that's the best repayment plan for them. For this particular person, right, they're using pay as you earn for some of their loans already. Other loans are in IBR 2009. If they consolidate them, they can continue using pay as you earn, right? As long as all those loans are in pay as you earn before it's phased out, they can keep using it for the duration of repayment. But if they were to leave pay as you earn after those rules take effect, then they wouldn't be able to get back in, right? So that's what's on the docket to happen. It's in the final evaluation phase now, and that's going to those changes are going to take effect in some form that is very close to what's written here. They may tweak it around the edges in the final rulemaking process, but this is largely what's going to be the new repayment landscape once the changes take effect. Now, the updates to REPAYE are going to be super beneficial, right? The monthly payment's going to be 5 to 10% of your discretionary income, depending on what your proportion of graduate school to undergraduate school loans are. Right now, most of us, the proportion of graduate school loans, because veterinary school is graduate school, is going to be very close to the majority of the loans. So it's going to be 10% or something very close to 10%. So maybe as low as 8%, depending on what your breakout is, but most of us are going to fall into that 8, 9, 10% of discretionary income. The bigger benefit is that they're going to protect more of your quote discretionary income, Right? So the way the discretionary income formula works, it uses a factor multiplied by the poverty guidelines. They're going to increase that factor. Right? So your new repay payment will be lower than your current repay or pay as you earn payment because they're going to increase this multiplying factor. The best benefit is the unpaid interest subsidy, right? So revised pay as you earn provides what's called an unpaid interest subsidy, meaning if your payments don't cover the interest, the government covers right now, the government covers half of what your payment doesn't cover. Right? Once the changes take effect, they're going to cover all of what your payment doesn't cover. Right? So all of that unpaid interest growth, the loan balance growing stuff is all going to be a thing of the past for anybody that's using this new version of revised pay as you earn. Right. So another reason why you want to stick a pin in that one to see if that's going to be the best repayment plan for you to use if you're not already using it. Right now, we've got a little bit of a problem, particularly for those of you that are married, because revised pay as you earn is one of these weird plans that even if you are married and file your taxes separately, they don't allow you to exclude your spouse's income. Once these changes take effect, they will. Right. So if you're married now and you're using the old version of IBR because repay isn't beneficial, wait until these changes take effect and then you can switch over to the new version of repay. Right. But that's, again, we're going to have to wait for that to officially take effect for you to benefit from those particular changes. But for those of you that aren't married, or repay is going to be a good plan for you while you're doing your internship and residency, you can choose that one or start or continue using that one now. One of the other plans that is going to become more beneficial because of these changes is the new version of IBR. Now, the new version of IBR has some special eligibility requirements. Right now, the two examples that I highlighted tonight so far aren't eligible for the new version of IBR. Right, and these are the rules for determining whether or not you're eligible for those different versions of those plans that have these requirements. Right, so this is another reason why you want to upload that student aid data file into here, because the student aid website and your loan servicers don't do a very good job of telling you the plan that you're actually eligible for. Right, they just kind of show you all of them, and then they let you then choose, right, which leads to a lot of mistakes. Right, so you want to know which plans you're actually eligible to use before you choose one, and then choose the one that's the most beneficial for you. And we're going to talk about this in a little bit, right? So these suite of changes create this new opportunity to use repay while your income is low, but then switch over to the new version of IBR if you're eligible for it, so you can still hit forgiveness sooner. Right, so that's going to be one of those really, it's going to be a combination strategy that's going to be super beneficial for those folks that are eligible for the new version of IBR 2014. All right, so how do we know that, right? So I'm going to show you the eligibility requirements. I'm also going to go through this discretionary income calculation so we have a better idea of what that payment number will be, particularly as we approach the end of these pandemic forbearance benefits. So the discretionary income is a defined equation. We take your taxable income, we subtract off this allowance, right? Right now it's 150%. The changes will make it 225% for that new version of revised pay as you earn. And then we're going to take 10% of that in most cases to generate the payment, depending on the plan that we're using. Right, so if you've got the average resident salary right now is $40,000 a year, if you're using pay as you earn, revised pay as you earn, the new version of IBR, $40,000 a year, we subtract off 1.5 times the federal poverty guidelines, gives us a discretionary income of $18,130 per year. If I take 10% of that, my minimum monthly payment is $151. Right, so that's what I have to pay to keep my loans in good standing at $40,000 a year. And when the repay changes take effect, that's going to drop all the way down to $60 a month. Right, so you're really rooting for these changes to take effect sooner rather than later. Right, now, hopefully it won't be too far into 2024. It may even be sooner. Right, but we really want that effective date to be as soon as possible so we can keep those payments as low as possible. So how much should you pay, right? It depends on how much you're earning, right? So I know a lot of you, $60 a month is going to feel like nothing. And you're going to, be tempted to pay more, but don't, right? Pay what your income requires you to pay. You have better things that you can be doing with any disposable income you have, right? Let your income set the minimum monthly payment. And depending on where your income lands, you'll either pay your balance to zero or you hit forgiveness or you'll hit forgiveness, right? Either is fine, right? But it pegs your monthly payment to a manageable percentage so you can do other things with your income other than paying your student loans, right? That's really the lesson of the income-driven repayment plans, is that you don't have to pay more than your taxable income requires you to pay, right? So pay that minimum, get that forgiveness credit building in case you need it, right? And when you get to a point where you have so much disposable income that you don't know what to do with it, then you can consider paying more towards your student loans if it makes financial sense to do so, right? There's no reason to pay more than you have to towards your student loans now. There's better things you can be doing with that money. All right, so just a little bit more on the income-driven repayment eligibility. So there's two plans that have new borrower requirements, pay as you earn and the new version of IBR. I know those requirements are different. We've got them baked into the My Student Loans tool in the Student Debt Center, right? So if you upload that text file, it will show you whether or not you're eligible for pay as you earn or the new version of IBR based on your loan types and when you first started borrowing. All direct loans are eligible for revised pay as you earn. So if you consolidate your loans into a direct consolidation loan is a direct loan, they will all be eligible for revised pay as you earn, regardless of when you started borrowing. Right? There are no new borrower requirements for revised pay as you earn. Everybody with a direct loan, all of those direct loans can be paid under revised pay as you earn. You are either eligible for the old version of IBR or the new version of IBR. You can't be eligible for both. Right? And I see a lot of people get confused by this. Right? So even when they're using the simulator, right? And unfortunately, we don't have it to be smart enough yet where we can just show you the one that you're eligible for, but the My Student Loans tool will, right? So you'll know which one you should focus on in the student loan repayment simulator based on what the My Student Loans tool shows you you're eligible for, right? But in most cases, and IBR 2009 was kind of the initial income-driven plan that everybody used, right? And the older loans were eligible for it, which made it nice. But once the changes to repay take effect, I can't think of any reason why anybody would want to use IBR 2009 anymore. Right now, there are specific reasons for using it right now, but once these proposed changes to repay take effect, there will be, again, I can't think of a reason why anybody would not choose revised pay as you earn over the old version of IBR once that takes effect. You will still be stuck with it if you don't consolidate these older FELs, if you have them before the end of this year, though, right? So look and see if you have those. If you were in higher education anytime before 2010, there's a really good chance that you still have some FEL program loans if you haven't consolidated already, right? And even if you did consolidate, right? So there was FEL consolidation loans before there was direct consolidation loans, right? So if you were in school at any point using student loans before July 1st of 2010, you definitely want to do that physical exam of your student loans and see if you still have any of these older FELs lingering around. Consolidate them, make them eligible for repay, and your loan repayment strategy will improve greatly. Parent Plus loans, I get asked about them infrequently, right? Mostly because your parents borrowed those to help get you through undergrad. Right now, they can only be paid using the oldest income-driven plan if you consolidate them, called income contingent repayment, right? And I see a lot of veterinarians who are trying to figure out ways to get those loans into their loans, and you can't do that, right? You can choose to pay those loans on behalf of your parents, but they're in your parents' name, right? So even if you didn't make those payments, it wouldn't reflect poorly on you, although your relationship with your parents might get strained, right? It's going to affect your parents' credit if they're not making payments on them. They're really weird loans. I don't know why they don't try to improve those and make them beneficial, but they don't. right? So if you have parents or you're the parent who has Parent Plus loans, just know that if you need some relief, you can usually find that under income contingent repayment, depending on what that parent income is. All right. So
I
this is
was gonna
another,
say, do you want to do a couple of quick Q&A sessions? We're at the top of the hour here.
sure, yeah,
And I also wanted to announce Olivia Lockyer as our first winner of a VIN Foundation Yeti mug. Olivia,
cool.
you'll get an email from us at vinfoundation.org. It'll be from student debt at vinfoundation.org, and we'll get your information to be able to send that mug to you.
Congrats.
All right, let me see here. I had a couple of Q&A questions I wanted to touch base on. Um, does that mean I can stay on pay for the 20-year payment period? I've been enrolled in it for 2 years now.
Yes, if pay as you earn is the best repayment plan for you, as long as you're in it while after those changes take effect, you can keep using it for as long as you'd like. Right. But I would encourage you to just take a peek, right? Whether or not you're eligible for the new version of IBR, right? If you are, then it may make sense for you to switch from pay to repay to take the benefit of the unpaid interest subsidy, because pay as you earn does not provide an unpaid interest subsidy, right? So if you're still doing the internship residency thing and your income is still quite low and you're anticipating accruing a bunch of interest for the remainder of your training, then it may make sense for you to move to repay, provided you're eligible for the new version of IBR. Right. So the reason why you want to check the new version of IBR is because after those changes take effect, right, anybody who's not using pay as you earn at a graduate school level, right, the new version of IBR is going to be the only plan that provides forgiveness after 20 years. Right. So that's kind of where the risk is. Right. Revised pay as you earn is awesome. Right. Particularly internship residency timeframe. However, if you're projected to reach forgiveness, it has a 25-year maximum repayment period, which means you're in repayment longer, you're going to pay more towards your student loans. Still beneficial, but not as beneficial as a plan with a 20-year forgiveness plan. If your only 20-year forgiveness plan that you're eligible for is pay as you earn, then stick with it, right? Because that's going to be more beneficial, most likely, than the improved revised pay as you earn, even with the unpaid interest subsidy, right? But you want to run that, you want to test that in the loan repayment simulator. We can show you the numbers on that. We do have the projected changes to repay, we call it repay, in the loan repayment simulator, right? So you can measure that, right? Again, you can't manage what you don't measure. You can measure whether or not it makes sense for you to change from pay to repay, right? And if you need any help with that, that's why we have the student debt message board area as well. I
Got
know
another
that's,
one.
go
Oops,
ahead.
sorry, go ahead.
I was going to say that I know that stuff is really, really confusing, right? But if we can kind of step you through the process there and you have kind of that knowledge in your head, right? Then we can talk you through it, right? We can get you into the right repayment plan. But again, it's kind of time sensitive, right? You can still stay with pay if you're not sure, right? Because that's the best thing to do, because if you're in it, you won't get, you can still keep using it, right? But at the same time, if you're going to be in an internship residency for a little while and you're going to get charged a bunch of interest, you may want to take advantage of revised pay as you earn if it turns out you're eligible to switch to the new version of IBR later.
And if we are already on repay when those proposed changes come, will they automatically apply to us?
I hope so. I don't know though. They haven't said that yet explicitly. I suspect that will be the case, and if not, it'll either require you to submit a renewal once the changes take effect, or the next time you're due to renew, those changes will take effect, right? So it won't take any longer than a year or when you're next due to renew, which is kind of where we're heading next in the presentation, right? These renewal dates or anniversary dates are super important as the pandemic forbearance benefits wind down, right? So all of this is going to become a timing exercise, right? Of when the changes take effect, when you're next due to renew, when the interest gets turned back on, when you're due to actually earn enough to generate a payment that's above the monthly interest accrual, right? It's all timing, right? So it's going to depend on a lot of those factors.
If you could expand on that a little bit more, because the next question here is how soon do we need to select a repayment plan before they automatically enroll us or put us in deferment in the case of being in a residency?
Yeah, okay. So first, if you take nothing else out of this presentation, do not defer your loans. Don't let them defer your loans. Don't request them to defer your loans. Right? If you haven't chosen a repayment plan, right, and you can see that if you go through this physical exam exercise that we were just going through, and you don't see a repayment plan selected on there with a name and a minimum monthly payment, right? You probably haven't selected one, which means your student loans are going to enter that standard 10-year plan payment once the pause ends, right? If that's the case, then apply now, right? You can apply for your repayment strategy now, right? Pick the most beneficial income documentation you have available, which is hopefully a 2022 tax return, right? That shows a relatively low adjusted gross income, but you could use that as income documentation to apply for an income-driven plan like repay, pay, depending on what your eligibility is.
Great. And then the last thing I wanted to mention here is I know you'll be getting to this section here soon, but there was a question about could you detail when running a simulation on the loan repayment simulator, how do you account for the fact that you expect your salary to drastically increase once you finish internship and residency and specializing? So
Yeah, though that's a great question. Let's demonstrate that here, right? So after I've uploaded my student loans and I've added any loans that I might need to add, in this case, we added those health profession student loans, and I've looked at the loans, the plans that I'm eligible for, so I know which ones to focus on in the loan repayment simulator. I'm going to click this send values to the repayment simulator. Right, it's going to take my principal, my interest, my weighted average interest rate, and it's going to populate all of that in the loan repayment simulator. Right, so the top section is pretty much already done for you. Right, now this person graduated in 2023. Now this is where the one-time forgiveness count adjustment comes into play. Right, if this person consolidates their loans, right, and they receive 3 or 4 years, let's just be conservative and we'll call it 3 years. I'm going to give them 3 years of repayment time, which is going to translate to 3 years of forgiveness qualifying time on their new consolidation loan, right? I can add that years in repayment, I can add 3 to it, right? Because that's going to count towards that time towards forgiveness. Now, this is the 2023 grad, right? Now, if you're just graduating this year or graduating in the future, you're going to see an advanced education plans section in the income information section, right? So let's say this person is going to do a 1-year internship at $40,000, and then they're going to do a 3-year residency at maybe, let's say, $45,000, right? And then after that, let's just guess something, right? I think this person actually said they were going to do 200,000 after the specialty training. Right now, that'll get you in the ballpark, right? So that's going to populate your internship, residency, and then start you at the 200,000 that you're projecting after that training is completed. Right now, for new grads, we talk about making sure that you file a tax return before you graduate, or if you start the consolidation before you start your internship, you can click this button, reduce first year and second year's income. Right, because that first year's income is going to be based on that tax return you filed as a 4th-year student, which is going to show something close to 0, right? And then you're starting your internship midway through this year, which means your $40,000 of annual income will actually only be about $20,000 of income when you file your taxes for 2023, which means your first 2 years of payments after school are going to be 0. The minimum monthly payments will be 0 based on those values, right? You don't start to get into a payment greater than 0 as a single person until you get into the mid to low 20s. And after the changes for repay take effect, you don't get greater than 0 until your income is somewhere in the 30s and close to 40s, right? So you want to make sure that you're using your most recent adjusted gross income from a tax return as the income that you use in the simulator, right? Because that's what's going to determine your minimum monthly payment. That will give you a more accurate projection of your student loan repayment simulation. And this will also adjust because when you finish your residency, you're going to finish your residency in July or August, right? So you're going to have a half a year's worth of residency income and a half a year's worth of your new specialty income. So you're going to have kind of a blended adjusted gross income in that transition year, just like this year's is a blended income of your fourth year and first year internship income. This is going to be your final residency year plus half of your projected annual income after you finish your residency training, right? And then it'll start to ramp up, right, as that income hits your adjusted gross income on your tax return, right? So that's how I would use this. And it's easiest, it's kind of set up to be easiest as a student who's just graduating or hasn't graduated yet, right? So we can run this simulation, right? And we didn't have to do much but enter a couple of values here, right? Now you can add your family information in here. Are you married? Yes, no. Do you have a popular? Not yet, right? That's going to tell the simulator whether or not to include your spouse's income, include any spouse's student debt that they have. If you've got dependents or plan to have them in the future, all of that plays into the family size, which impacts that discretionary income calculation. Right? If you're going to hit forgiveness, we want to guesstimate a tax on that. Right? It's just a guess for now. Right? We start you off at 30%. You can change that to whatever you'd like. If you're going to hit forgiveness and have to pay a tax, we want to save for it. That's what this is about. Right? Right now, I can get more than 4% on a savings account. Right? So even if I just took my forgiveness savings and put it in a savings account, I can probably get 4.5%. Right? As you build a forgiveness savings, a dedicated forgiveness savings, you can add that. You don't really need to worry about that in this particular case. Right? But I'm going to run that simulation, and this is what's going to get me in the ballpark of whether or not I'm projected to hit forgiveness. Right? So I know that this particular person was eligible for pay as you earn. Right? So I'm going to first kind of focus on that one. I'm looking, I can see I don't have any payments for a long time on my student loans that are much greater than zero. I'm projected to pay $265,000 in monthly payments. I'm going to have about $137,000 of principal forgiven. A 30% tax on that is about $40,000. The total projected cost of that is about $305,000, which is the lowest in this chart, aside from the standard 10-year plan payment. However, that presumes that you can make a $2,300 payment during your internship and residency, which is probably not likely, right? So someday I'm going to fix that, right, for interns and residents where we won't actually total that up as like it's some kind of viable pathway for you, because most of you, particularly a single person, is not going to be able to make a $2,400 a month payment while they're earning $40,000 a year, right? That's going to be 80% of your take-home pay, right? So this isn't really attainable, right? Which makes this the next best alternative, right? So in that case, I would be, and since it's better than repay, I would be choosing that pay-as-you-earn repayment plan as part of that consolidation and looking to see if I receive that 3 or maybe even 4 years of forgiveness qualifying credit under the one-time forgiveness count adjustment, right? And that's a pretty good outcome if our simulation is accurate, right? And as you get closer to the end of your residency and you have a better idea of what your income is going to be, you can update that. These numbers will update. You can see if it makes sense to stay on that pathway or change gears, right? But for right now, what this is telling me is I want to consolidate those loans. I want to choose pay as you earn. I'm going to look for how much forgiveness credit I get when they apply that number later next year, right? And I'm going to adjust that each year as my circumstances unfold. Right, this will give you kind of an idea of how much you need to save for that forgiveness. I wouldn't worry about that during your internship or residency, right? Because you're going to have ample time once you finish that specialty training, if you're truly going to earn more than $200,000 a year, to ramp up that forgiveness savings plan at that time. right? So focus on, keeping your budget in good order during that internship residency training, making sure your loans are in the right repayment plan and that you're renewing your income documentation each year on time, right? So this thing is a possibility, right? And don't worry so much about this until you're actually done with your specialty training and earning something that's more than a trainee income, right? And by doing the forgiveness savings plan, we've even reduced that total repayment cost, and it got even closer to what it would have been had you been able to make those payments under a standard 10-year plan, right? So this is, again, just illustrates how beneficial these income-driven plans are, even for somebody who's got more than $200,000 in student loans, but anticipates earning well over $200,000 after they complete their training, right? There's still a place for these income-driven plans with forgiveness to make a lot of financial sense. And it's going to give you a lot of financial flexibility leading up to that potential forgiveness event. Good question. Yeah, and you guys, if you keep asking those questions. I mean, again, I don't anticipate we're going to get through nearly close to all of the slides, right? So I mean, and I'm not going to even try. So I mean, we can go through, just the questions and answers, illustrating the tools, and we've touched on a lot of these concepts already. And really, what I want to focus on the most is that physical exam, right? What you can do right now to make sure that you're not missing out on any of these super beneficial opportunities, and setting yourself up to make sure that you stand to benefit maximally from those opportunities that are in front of you. So the renewal date is another one of these, right? So the renewal date applies to income-driven plans only, right? So if you've been using an income-driven plan, you'll know that you have to provide updated income information at least yearly. Now, nobody's had to do it during the forbearance benefit period. That was shut off as part of the forbearance benefits, right? So a lot of us have kind of forgotten how to do that, right? And this is one of the things I'm really worried about when payment starts back up. I mean, this is going to be a complete cluster, right? Because the anniversary date in the file are not quite all updated and not quite accurate, although we can, based on the guidance that's available, we can actually make some pretty good assumptions of what it's supposed to be based on what we do see in there. But if you're using an income-driven plan right now, then you should have an anniversary date, right? So I'm going to come back to my examples that I've been using, right? So we can see here that this person's anniversary date is December of 2022, which is past 7 months ago, right? So that's not updated, right? But we know from the Department of Education guidance on these anniversary dates, as it pertains to the continued pandemic forbearance benefits, that if your anniversary date falls between now and the end of this year, you can add another year to it. Now, this person needs to have another year added to that even, right? So we keep adding a year until we get to this range of dates that falls between now and the end of this year, or 6 months past the end of the pandemic forbearance benefits, right? And whatever that date is, we add a year to that, right? So this particular person doesn't need to provide annual documentation of their income again until December of 2024, right? Which is a long way from now, right? Their monthly payment is zero, right? But now this is also the one that has a very complicated mixed loan type portfolio, right? And they really, really need to consolidate these loans, right? Now they can wait a little bit longer, right? But they can't wait beyond the end of the year to make sure that they still preserve all of the forgiveness time that they've already earned. But they also want to keep this monthly payment of zero for as long as they can, right? So you can get cute if you want to here. I wouldn't recommend getting too cute, right? I mean, honestly, it wouldn't be wrong if this person consolidated tomorrow, right? Because it's going to take 30 or 60 days for that consolidation to process anyway, right? But the last possible day that you can submit a consolidation is December 31st to still benefit from the one-time forgiveness count adjustment, which is a necessity for this particular person, right? So it's worth giving up that monthly payment of zero when you have a loan portfolio that looks like this. When you consolidate, you're going to have to reapply for income-driven repayment, which means you're going to provide recent income documentation, and it's going to set a new anniversary date, right? Which will be no more than a year or no sooner than a year from now, right? So those are the things that, we're looking for that anniversary date in here, trying to make sense of when I'm next due to renew. What does my monthly payment minimum show me? Do I need to act on my student loans before the end of this year? In this case, the answer is yes. Is that going to change my minimum monthly payment? Yes. Right. But it's going to be worth it to get all of the loans into pay as you earn in this case. If I come back to my other example, right, I don't have an anniversary date because this person's never used an income driven plan before. Right. That's another tip off that this is the most common thing that I've seen from students that have actually, I have an example of this. So somebody that graduated in 2020 that said that they're using pay as you earn, but it doesn't show that in their file. Right? Now, you may have thought that you applied for it, or maybe you applied for it during your grace period and they ignored it, right? But if you don't see an anniversary date, or you don't see a student, an income-driven plan listed in your file, then you're not in one. So that you're going to want to check that and make sure that that's the case for you. I think that, let me see which one of these is the 2020 grad. 1536. Yeah, it was like, I was expecting, again, some of you get used to doing these. It's just like veterinary cases, right? You get used to doing and seeing certain things, and I did not see anything normal in any of the files that you guys submitted. So here's a good illustration. Another benefit that's floating around there. This is the one the Supreme Court's ruling on, right? So the Biden administration proposed canceling $10,000 or $20,000 of the student loans, and that 10 or 20,000 was dependent upon whether or not you received a Pell Grant. If we find a Pell Grant in your student aid data file, we'll identify it, right? This is what this box means. Special cancellation criteria met. This person has received a Pell Grant, which means if the Supreme Court allows those cancellation benefits to go through, they will have $20,000 of their loan balance canceled, right? Great. That would be wonderful if that happens. I don't think it's going to happen, but we may all be pleasantly surprised, right? But that's what this indicates. Now, this person also told me that they were using pay as you earn, right? But they're not. Their loans are all listed in forbearance with no anniversary date, which means the Department of Education doesn't have record that they're using an income-driven repayment plan, right? They're eligible for pay as you earn, right? Which is great. So they can apply for that. And this is another one where I found a random old loan in here before they started veterinary school that probably, if they consolidate all these loans together, they're going to receive 3 or 4 years of forgiveness qualifying credit just because they had this one loan that has some repayment time, most likely because there's a pretty good gap here between when they took that loan and when they started veterinary school, which tells me that there's a good chance that they're going to get that forgiveness credit if they consolidate them. So I would be running to consolidate these loans and applying for a plan like pay as you earn or revised pay as you earn. Right, so the physical exam of those student loans is critical. Any other questions on the anniversary date? We released a blog post just last week on that aspect because that's going to be really, really important. If people have been trying to submit renewal information, even when it's not really due, and they won't process it, right? So if it's not due and it won't actually reduce your monthly payment, they'll ignore it. And sometimes they won't really tell you that they're ignoring it, right? So the income-driven plans are kind of administratively finicky like that, right? So you have to know enough about them to navigate them appropriately. But if you can navigate them appropriately, there are tens of thousands of dollars of savings at your disposal and being done with student loan repayment sooner rather than later, if you can do it, right? So it's worth this time to look into some of these options and use these resources to help you identify this information to make those decisions.
We do have a question that I heard you can use pay stubs in place of your previous year's tax return. are you able to use a 2023 pay stub in place of your 2022 tax return?
You can. It can't be any older than 90 days. Right. And if you're going to provide a pay stub, make sure that you're highlighting. I've done this, right? So I just don't ever submit them a pay stub by itself. Right. I submit the pay stub as the documentation, but then on the pay stub, I'm highlighting any pre-tax deductions that are coming out of there, right? So health insurance, HSA contributions, if you're contributing to a retirement account, right? Anything that reduces your gross income on a pre-tax basis, you want to highlight for them, right? And then you have to tell them how often you're paid, and bi-weekly or semi-monthly or whatever the pay period is, and multiply that by the appropriate frequency to get an annualized taxable income. Right? So the pay stub is kind of that base level piece of information that you have to submit, but you want to do the math on there for them. If you do the math on there for them, you'll get the monthly payment amount that you expect. If you give them the pay stub, they're going to start doing a whole bunch of weirdness, and you're not going to know how they calculated your monthly payment. They might get it right, but chances are they won't. Right? So do the math for them. Calculate out what your annual taxable income is based on that pay stub, and then do the 10% of the discretionary income calculation for them. And if they come back with a minimum monthly payment that's anything different than what you submitted to them, then you want to call and find out why.
What do you need to do if your residency income is so low and you pick up some additional income like ER or something like that?
Yeah, so that's where the tax return is really helpful, right? So your tax return will pick up on all that at the end of the year, right? So chances are, if you're a resident, unless you started your residency right out of school, which is, it's possible, but rare, right? You probably have a tax return on file from your internship year, right? They will always take your most recent tax return. Even if that most recent tax return is otherwise lower than your current income, you can still use that. That's the whole reason why we recommend fourth-year students file a tax return. We know that tax return is going to be really low, if not zero or negative, right? But the application says, has your income significantly decreased since you last filed your last tax return? Right? The answer to that question as a graduating veterinary student or a finishing intern is nearly always no. Right? It's almost hard to have an income that's lower. Right? So you can still use that prior year's tax return to satisfy the income documentation requirements. You can think of the tax return as kind of the gold standard for documenting your income on an income-driven plan. So if you're worried about the residency extra shifts and you're earning a little bit of extra income, don't use that. Right? Use the last year's tax return that might represent your internship year or maybe your first residency year where you weren't doing that, and that'll get you through the application process. And then when you file your taxes for 2023, it'll pick up all of that income from your extra activities. Right? Now, if those extra activities are inconsistent at best, then I wouldn't even include them. Right? It's kind of like production pay. It's not necessarily guaranteed. Right? So it'll hit your tax return, and if you still think that's a reasonable representation, you can use that tax return when it's available. Right? But if it's infrequent, then use your pay stub that shows your base pay, and that'll be good enough for your income documentation.
And what if you're a fourth year that did not file a tax return? How will this impact our ability to apply for pay or repay?
Well, you can still file one now. If you don't have any taxes to pay, then there's no problem with filing a tax return late. You can voluntarily file a tax return at any time. So you can still do that. Or if you haven't started your internship, then consolidate now, right? Because the other option you can use is checking the box that says, I don't have any income because I haven't started working yet, right? And that's a perfectly reasonable option to do as well, right? So you check a box that says, I don't currently have any taxable income, and they'll calculate your payment at zero. Right? Otherwise, you're going to have to use a pay stub you receive when you start your internship, right? But if you get this stuff started before that, which is kind of why we do the timing of these now, because we know most of you haven't started those internships yet, you still have an opportunity to submit that consolidation and get this process started.
I also wanted to announce that our second Yeti mug was going to Alyssa Chasnick. I hope I pronounced your last name correct. You'll receive an email from studentdebt@vinfoundation.org in the next couple of days, so we can get your information to ship that out to you.
Cool. I did want to, I just wanted to cover public service loan forgiveness because I saw a lot of questions about that in the registration submission. So any and all of you that are doing internships or residencies at academic institutions, I would highly recommend that you submit a public service loan forgiveness employment certification form, right? Even if you quote know that you're not going to work for a nonprofit after you're done with your training, document the progress anyway, because you never know where your career may take you, right? That is kind of one of the most common things that I see are people who started out in private practice and find themselves in some kind of nonprofit public service loan forgiveness qualifying position later on, right? And if the sooner that you can document that public service loan forgiveness progress, the sooner you can hit public service loan forgiveness. This is the holy grail of repayment, right? And those of you that are on that internship, residency, advanced training pathway are more likely than not to receive public service loan forgiveness credit and possibly public service loan forgiveness in the future, right? So don't discount it, right? If you're doing any kind of training at an academic institution, I believe you should be eligible for public service loan forgiveness. Now, internships, there should be no question. Residencies, it really depends on the residency program, right? The sticking point is finding a coordinator or HR rep or whoever the person there would be that provides you kind of your employment information if they're willing to sign off on the public service loan forgiveness employment certification form. There's a part on there that you fill out. There's a part on there that your employer fills out. And as long as they're willing to sign that form, you will get credit. Because every veterinary academic institution is a 501c3, right? So
we did have a question in the chat about what if your residency is abroad, like at a Canadian university?
Yeah, so that's not. So 501c3 is a designation for organizations in the US, right? So no, that's not going to be eligible, right? But any US academic institution is a 501c3. Now there are some huge nonprofit organizations that have some massive international tentacles. And if you're paid by the mothership and employed by the mothership that happens to be based in the US with a 501c3 designation, then that will work, right? But a Canadian institution is not a 501c3 because they're not a US institution, right? But that was under a slide I have in here called special cases, right? So if you have US student loans and you're living, working, training in Canada, right? Your taxable income in the US is zero, right? So you can have a $0 minimum monthly payment on your student loans using a plan like REPAYE with the unpaid interest subsidy would be super beneficial, right? So you're not going to make many payments towards your student loans. The longer you stay in Canada, the more likely it is you're going to hit forgiveness, right? It might not be public service loan forgiveness, but it'll be income-driven repayment forgiveness, right?
And that would apply for other countries other than Canada as well.
Exactly. Well, countries where the US has special tax relationships like Canada, the UK, all of the most of the European countries. So if you live and work abroad there, you still file a tax return as a US citizen, but unless you're earning a lot of income overseas, your taxable income, your taxes in the US is going to be zero, which means you can have a minimum monthly payment of zero on your student loans for as long as you're there. Now that's going to make it likely that you're going to hit income-driven repayment forgiveness, but that's possibly not tax-free, right? So you're going to want to plan for that tax, whether you live in the US or not, right? So let me, where do I have that slide? It was right here handy. Right now, there is a tax exemption on all student loan forgiveness if you receive it between 2021 and 2025, but nobody here is going to receive it that fast, right? So if they extend that tax exemption, you may get lucky and not have to pay tax on forgiveness, but you should plan as if you're going to have to pay the tax. And if you're going to live and work overseas with US student loans, it's highly likely you're going to hit forgiveness and probably have to pay a tax. So you're going to want to plan for that. Still really beneficial, right? Just put it on your radar that this isn't like a no strings attached kind of thing, right? You can have a very low payment and you can get an unpaid interest subsidy, which will reduce the amount of interest that accrues, but you're still at some point going to hit forgiveness, which is going to trigger a taxable event, which is going to require you to pay some taxes, whether you live in the US or not. I see a good question here. I went to consolidate my loans and have some labeled in grace period and some in deferment and one in forbearance. All of those mean that your loans are eligible for consolidation, right? You're looking for grace period, deferment, or anything that has a repayment plan name will allow you to consolidate your loans. The only status that will not allow you to consolidate your loans is if they say in school, right? So in school just means that they haven't yet flipped from in school to the grace period or deferment status, right? So you can consolidate anything that has a status other than that in school status. If we consolidate, then wouldn't that be more detrimental than just paying off the highest interest loans off first? No, because where's that money going to come from, right? Working as an intern or resident, it's not like you're flush with disposable income, right? If you are, then you probably shouldn't have student loans, right? So it doesn't make sense to pay your student loans when you don't have disposable income to do so, right? And targeting or trying to snowball or avalanche student loans is a fool's errand, right? So they just don't behave like that. Might work really well for getting out of credit card debt and other less flexible debt, but your student loans, you're gonna play whack-a-mole, and you'll benefit more from the consolidation. Potentially even increase your forgiveness count if you have some older loans that were already in repayment, right? But it sets you up to pay less towards your student loans during your advanced training, and then you'll accelerate that payment once you have the income to do so, if it makes sense to do so. Should we have done repayment during the forbearance benefit if we know we qualify for public service loan forgiveness, or do we all get that time for free even if we didn't pay or got a refund? That's a great question, and one that I definitely wanted to address. So thanks for bringing it into the Q&A panel too. So yes and no. So the forbearance benefit period, if you were otherwise working for a qualifying organization that would make you eligible for public service loan forgiveness, will give you public service loan forgiveness credit after your loans finish their post-graduation grace period, right? So the normal course of events, if we dumb it down as much as we possibly can, veterinary school loans after you graduate enter a 6-month grace period, right? But you all start working, doing your internship a month or two after you graduate in June, when your loans are still in the grace period. Right, so that time, that overlap time where your loans are in the grace period, but you're doing an internship, is not public service loan forgiveness eligible unless you consolidated your loans and ended that grace period, which is why overall it's more beneficial to consolidate your loans than not, particularly when it pertains to things like public service loan forgiveness, but even more so now that this one-time forgiveness count is in place. Right, so consolidating those loans, ending that grace period, and getting your loans into repayment, even with the $0 payment, would make that time eligible for public service loan forgiveness. If you didn't do any of that, then the soonest that public service loan forgiveness credit could have started, if you graduated in May, would be around November or December. Right, so you lose out on about 5 or 6 months of public service loan forgiveness credit there if you didn't consolidate and otherwise end your grace period. Right. So again, you guys are kind of in that unique position where new interns are coming in and you can let them know all the mistakes that you made so they don't make the same ones. Right. So make sure that you're encouraging them to submit a public service loan forgiveness employment certification form, or if they're new grads, that they consolidate their loans and end that grace period early so they can start earning that public service loan forgiveness credit sooner rather than later. Right, but if once that grace period expired, even though the loans have been in that pandemic forbearance benefit period and you otherwise have been working for a nonprofit, then you should get public service loan forgiveness credit for that, but you won't see it until you submit the employment certification form, right? Then it'll show up in your student aid data file. There's actually a place for you to see that accumulated public service loan forgiveness time in this public service loan forgiveness status tab. right? I know it sounds like a lot, but that form is pretty basic. So fill out the form that you need to fill out, find that person that's going to sign off on your employment there, and then submit it. And you'll start to see that time accumulate in your student aid data file.
This question had an edit. Do I need to consolidate unsubsidized and the grad plus federal loans?
Yeah, consolidate them all. There's no reason to leave loans out of your consolidation. Those are some of the messy ones that it's really hard to make sense of when we do the student debt message board analysis. Like you'll see some that were consolidated and some that were left out of consolidation because maybe somebody said, hey, leave the lower interest rate or higher interest rate loans out. It's a mess, right? If you're going to consolidate all of them, particularly now before the end of the year. Because if you do, again, you can get that bonus forgiveness time applied under the one-time forgiveness count adjustment, right? There's never been a better time to consolidate, to clean all this stuff up. And the people that I find end up in the most precarious positions are the ones that, try to make the consolidation thing really complex. So again, there's way more benefit in consolidating than not. I know there are rare instances where that's not the case, but they're really, really rare. So if you think you're one of those, then please let's do that over on the student debt message board area, and we'll walk through that with you. I'm not sure I'm following the question here from Jessica. Where is this massive savings coming from? I'm not really sure. I mean, it's just it's kind of the terms and conditions of your student loans. So it's there for you to take advantage of if you want. If not, you can choose to do something else. So you certainly don't have to do any of this, right? But there are a significant amount of savings that are baked into the repayment options that you have available to you. In school, they really emphasize that consolidation is not good and we shouldn't do that. Yeah, I don't know why that would be. Again, I have in the past, if you had already logged a bunch of repayment time, then consolidation could work against you. But during this one-time forgiveness count adjustment period, consolidation is, I mean, again, I can't even count the number of times we've recommended that people or tell people they need to run to consolidate their loans. And I think there's been maybe one out of the thousands of these analyses that I've done over the last 10 years where I was like, oh, maybe it would have been better if they didn't consolidate once, right? So I don't understand why they would recommend not against consolidating. It doesn't make any sense to me. It's going to make your life a lot easier, and it's going to make more of your loans eligible for more of the benefits sooner. So, again, if you have a question about that, we can go through it on the message boards. But, as I illustrated in just some of the cases that we went through here tonight, consolidation is just like screaming, please consolidate these as fast as you possibly can. Let's see. I have some loans from undergrad that my parents have graciously agreed to cover. Is there any way to separate out payments? Or when I start payments, will I automatically be paying back the total of loans in my name? Oh, that one's a little more complicated than I could probably cover here, right? It's nice that your parents want to do that. Depending on your circumstances, you may encourage them to do something different with that offer, if possible. You can, I mean, if that's really the only thing that they want to do for you, or the only opportunity you have for those funds, then you can have them make that payment to those loans now and then consolidate the rest afterwards. But financially, there wouldn't be a lot of really good reason for them to do that, right? Your undergrad loans are some of the lowest interest rate loans you have, right? And the higher interest rate loans are the ones that are going to cost you the most, right? So I get it. It's one of those like things that you want to make a nice gesture and things, but financially, it's usually not the best way to attack a student loan portfolio. Any mistakes we might make, missing payments that could option for forgiveness disappear. I'm kind of losing that one. Is there anything that can affect the forgiveness outcome? Any mistakes we might make, missing payments that could option
Make-
for forgiveness?
Yeah, any mistakes like missing payments that might mess up your forgiveness, or could the option for forgiveness disappear one day?
So the option for forgiveness cannot disappear one day, right? That is baked into the contract that you signed that comes with the direct loans, right? Forgiveness is not going anywhere. What the tax is going to be on it can change, right? What the tax rate is, whether or not they let it be taxable, like we see with the tax exemption, but forgiveness is law, right? It's baked into the contract that you've signed that comes with your direct loans that's available with the income-driven plans. Right now, they tweak how the income-driven plans are executed, but they can't eliminate forgiveness, right? That would be against the law, right? So, but if you don't make payments on time, then they won't be considered forgiveness qualifying. So don't make that mistake, right? You can sign up for auto pay, right, where the payment is made automatically each month on time, right? That's the easiest way to make sure that you're not missing any payments. And you don't want to miss those renewals, right? Because if but you'll know if you missed a renewal because your monthly payment will go way up. Right now, so you can correct that quickly if you do miss that renewal. So, but yeah, try to just keep making those on-time payments based on your income. Provide that income documentation at least yearly when it's required, and you shouldn't have any problem with your forgiveness credit. And once they apply that forgiveness count adjustment, there's actually going to be a tracking mechanism in the file, just like there is for public service loan forgiveness. Right, you'll see what your progress is towards forgiveness, and it'll continue to build as you work towards it. I worked a lot as a student, but graduated in 2022, so my 2022 income should differ greatly from my 2023. Will this affect my ability? Yeah, I would need more. I would need numbers there, right? I don't know what greatly is, right? We'd have to know what the number is, but I know that until or unless your income exceeds $20,000, $30,000, $40,000, you're not going to generate a payment that's greater than zero, right? So, but if you're in some other range other than that, then and your income is currently lower, then you may want to use your current income as documentation rather than your fourth year income from school. Does changing repayment plans reset the repayment clock? Absolutely not. Right, that question is commonly asked, commonly confused, right? So changing plans does not reset your clock. Consolidation used to reset your clock, but it doesn't right now, right? Which is why that one-time forgiveness count adjustment is so beneficial. If you are in pay-as-you-earn, can you switch to revised pay-as-you-earn once available? Yes, you can. You can always switch between plans, and actually switching between pay-as-you-earn and revised pay-as-you-earn has become more beneficial. Usually switching prior to July 1st, so 3 weeks from now, switching plans would trigger an unpaid interest capitalization event. But after July 1st, there will be no unpaid interest capitalization switching from pay to repay or repay to pay. What about universities that classify residents as non-degree seeking graduate students? Oh yeah. I still think you should be eligible for the public service loan forgiveness employment qualifications, right? Find a friendly person over there that's willing to sign that document. I just don't understand that whether they consider you a non-degree seeking graduate student or not, you're still working more than 80 hours a week doing those resident duties. I mean, it's still more than meets that spirit of that public service loan forgiveness benefit. And the physicians have been doing it for decades, right? So since public service loan forgiveness has been a thing, physicians have been working and mostly receiving public service loan forgiveness before they're even done with their training because their training takes so long. So it's kind of ridiculous that some of our veterinary institutions aren't willing to sign off on that public service loan forgiveness credit. If anything, it should be a baked in recruiting benefit for residency and thereafter. I mean, having that opportunity to earn public service loan forgiveness for those of you that are carrying some big student loan balances is huge. right? So being able to earn some of that public service loan forgiveness time during that training, and then maybe turning that into an employment opportunity to satisfy the public service loan forgiveness requirements seems like it's a win-win for everybody. So in the case of us that have just started residency in June, if we haven't filed a tax return before we start our residency, we can't file a tax return now and use that. Well, if you just started your residency this June, I'm guessing you filed a tax return for 2022, no? Unless you didn't have enough income to do so. Right? If you have a 2022 tax return on file, you can use that. If you don't, then you can use your residency income that you're just starting with to document your income for repayment purposes, right? But I suspect that you probably have a tax return on file for 2022, right? And if you do, then use that. Is there somewhere to track our progress towards forgiveness with pay-as-you-earn? Yeah, I covered that. That's when the one-time forgiveness count adjustment happens, that will be something that we will be able to see in the student aid data file. And the pandemic period does count, right? So the time in since the pandemic benefit started, provided your loans were not in an in-school status, will count towards the forgiveness under a plan like pay-as-you-earn. You won't have to do anything. That's going to be part of the forgiveness count adjustment that'll be applied, and that hopefully everybody will be able to see in their file once they start tracking that. What if my internship pay was more than my current residency pay? Is that going to hurt me for my most recent tax return? So that's the benefit of having multiple options, right? So it asks you, has your income decreased since you filed your last tax return? In that case, where your internship income was higher than your current residency income, the answer is yes. So then you wouldn't use your tax return, you would use your residency income instead, right? Because it's going to generate a lower payment. That's the spirit of these income-driven plan payments, is to not have your payment be a punishing amount of your income. Right? So if your current income is lower than it was last year, then you use the current income. If your last year's income was lower than your current income, then use the tax return from last year. Right? All of it's going to catch up eventually, right? As your income increases, it's going to hit that tax return that you then use to submit your documentation the following year. Right? So again, the spirit of the plans are not to screw you, they're to help you. Right? They're to help you have a payment, a reasonable payment based on your current income information. All right, I just graduated this year and it still shows my loans are in school. How long will it take for my loans to reach a status where I can consolidate them? Sometimes it takes a day. Other times it takes a month. If it's been more than a month, then I would call your financial aid office from the school you graduated from and ask them why your loans are not yet in a grace period status. But check frequently as soon as there's some variability there, but oftentimes it happens really quickly. Sometimes you have to wait a little bit. So to be clear, public service loan forgiveness doesn't accumulate until the form is submitted. You won't be able to actually see any of your public service loan forgiveness progress until you submit the form. Right? You can still document public service loan forgiveness, but you don't have to submit a form at all until you actually reach the end of public service loan forgiveness. However, if you do that, you have to then go find all of those employers that you worked for during that 10-year public service loan forgiveness employment progress and have them sign the form retroactively, right? That might be pretty tough to do. It's probably not going to be hard to find the last couple of years, but when you start getting into 8, 9, 10 years ago, that's going to be difficult. Right? So if you want to make public service loan forgiveness easier rather than harder, then submit that employment certification form at least each year or whenever you change organizations. Right? If you're doing an internship at one academic institution and a residency at another, submit one to the internship institution and then submit one at the new academic residency institution every year for those residency years. Right? And then when you get to the 10 years of qualifying time, when you can actually apply to have the loans forgiven tax-free, you're going to have 9 or 10 public service loan forgiveness employment certification forms to submit with that which is going to make them approving that application a lot easier. Right? So it's really just to help you make public service loan forgiveness easier rather than harder. Get them to document that progress while you're there, right? Instead of waiting and then having to go back and find them later. But if you do that, you'll see that progress in your file, and MOHELA, because your loans will be moved over to MOHELA, they will start documenting that public service loan forgiveness progress. If you don't document that progress, then you won't see any numbers in there, right? You're just kind of crossing your fingers that when you hit the 10-year mark and apply and document it all at that time, that they're going to approve it all, right? And that's a really risky way to do that. If I'm going for public service loan forgiveness, do I consolidate now and then get the form filled out by the university for my internship, or should I wait to consolidate until I have the form filled out? That would really help me to know if you're kind of a new grad or where you are in the process. Generally speaking, but a new grad. So ideally, graduate, consolidate. As part of the consolidation process, you're going to get your loans into an income-driven plan, and then once you start that internship, then you can submit the public service loan forgiveness employment certification form. That would be the ideal course of events.
And then the forgiveness count clock will start ticking. Sorry, I'm trying to summarize some of the other questions here. Will start ticking once that consolidation is completed. The time during the consolidation does not count.
Correct. Once the consolidation loan, because your loans that are being consolidated, presuming you're a new grad and your loans are in the grace period, the loans that are being consolidated are kind of in this grace period status that are otherwise not eligible for public service loan forgiveness. Once that consolidation loan is complete, you have a new loan that is now in repayment, that as long as you're also then working for a public service loan forgiveness qualifying organization, that PSLF time starts from that point, that the loan was consolidated, provided it overlaps with the start of your internship.
And there was a question about picking a plan at the time of consolidation, which yes, you can pick your repayment plan at the time of consolidation. She just said she wasn't sure which plan to pick yet, but wanted to start the $0 payments towards PSLF.
Yeah, if you're not sure which one to choose, right, then choose either pay as you earn or revised pay as you earn, right? Again, either one of those are going to result in a $0 monthly payment, provided you're not married and your recent tax return doesn't show a joint with spouse income on it. You'll get that public service loan forgiveness credit started. If you've left the loan out of consolidation, we should still be able to reconsolidate to fold the stragglers in. Yeah, it also depends on when you started that consolidation. So if this was a recent consolidation, you have 180 days from the time you consolidated to include loans that you may have left out, right? So it'll get included in that same consolidation. If it's been more than 180 days since you last consolidated, then it will be a new consolidation loan. In which case you may consider including the consolidation in with the stragglers to generate one new consolidation loan. Right, but that's another one where I'd really like to see the details and the specifics before you do that, just to make sure. I wanted to make sure I'm understanding this correctly. Would IBR be more ideal if you are planning on applying for public service loan forgiveness? It's actually required. Right, so and this maybe I didn't make this clear enough, or we didn't spend enough time on that public service loan forgiveness slide, but in order for you to reach public service loan forgiveness, you have to use an income-driven plan. Right, you can also use a standard 10-year plan, but if you make standard 10-year plan payments, you're going to have a zero balance at 10 years, right? So there's not going to be anything left to forgive. In order for you to have a balance that's eligible for forgiveness under public service loan forgiveness, you have to use an income-driven plan. And ideally, you want to use the income-driven plan that's going to generate the lowest monthly payment. So you maximize the amount that can be forgiven. Right? And that's all kind of baked into why you want to have that $0 payment in the first 12 months if possible, and the second 12 months, right? Which is doable depending on your internship residency circumstances in most cases, right? Some of the higher paid internships, which we have been seeing lately in private practice, right? Which also corresponds to the person who said my residency income is lower than my internship income. That's a very real possibility these days. So you may have a little bit higher monthly payment for a year than we're showing in that example simulation I ran, right? But overall, that's still, you need to use those income-driven plans to keep your payment low based on your income in order to have a chance at reaching public service loan forgiveness.
Not sure if you saw the second part of that question. Do you submit that form as soon as you start training at this facility or the end?
You could do both, but it's only going to count the number of qualifying payments from when your employment started to when you submitted the form, right? So if you want to get the clock tracking, you can submit it after you start, but then submit another one after you finish, particularly if you're leaving that institution, right? You may want to make sure that you get all of that time documented. Right now, you could wait until the end, right? But you're not going to see the actual numbers of qualifying payments then until after you finish your internship and submit the form, right? So it's up to you on how you want to manage that particular data point for public service loan forgiveness. Let's see, my loans are still in forbearance. How do I know which repayment plan I am currently enrolled in? When do I need to select a plan by? So again, upload that student aid file into the My Student Loans tool. If you don't see a repayment plan in your file, then you may not have selected one yet, right? Or it just hasn't hit your file, right? So if you want to confirm that, you can confirm it with your loan servicer, or if you know you haven't applied for a plan, then apply for one now. Right now, if you're a new grad, right, the forbearance benefits are going to end at the end of August, the latest. That's still during most new grad grace period, right? So you won't have a payment start then, right? But you're also not earning any forgiveness credit. So if you want to select a repayment plan and you're in your grace period, you're going to need to consolidate your loans, right? Because you can't apply for a repayment plan while your loans are in the grace period, right? That you have to be knocking on the door of the end of that grace period, or you have to consolidate and voluntarily end that grace period to get your loans into a repayment plan. And if you graduated a couple of years ago and you still see forbearance, that's like the other example that I illustrated, right? That's a case here where this person most likely hasn't chosen a plan yet, right? So they're going to want to, as we also illustrated, consolidate and choose a plan as part of that consolidation. Does consolidation reset the PSLF forgiveness clock? That is a wonderful question. If you already have public service loan forgiveness time and you consolidate, they will calculate a weighted average of your public service loan forgiveness eligibility. So if you are, let's say you discovered that you had loans that aren't eligible for public service loan forgiveness, right? So I've got health profession student loans and I know that I'm going to be in public service, so I want those to be eligible too. And I want to consolidate those that have, 2 years of public service loan forgiveness credit. You will see some of that public service loan forgiveness credit reduced if you consolidate all of those loans together. But it'll be a weighted average based on the balance and the public service loan forgiveness time you have, right? So that's one of those instances where I would really love to take a look at your student loans before you consolidate, right? If you already have public service loan forgiveness credit and you're considering consolidating your loans, right? That's where we want to take a closer look at that and see what that might do to your public service loan forgiveness credit. Now that's actually a special new benefit, right? In the past, if you consolidate your loans with public service loan forgiveness credit, it automatically reset the entire clock. Right, the weighted average thing is another one of those new benefits that's going to be live as of July 1st. So again, the changes that are made to income-driven repayment, other than eliminating pay-as-you-earn, all of them have been more beneficial rather than less. Right, so it's that is again, that's a great question, and I would really love to see your loans before you consolidate those, just in that case that you already have some public service loan forgiveness credit. Another great question there. I saw, maybe Becca, you already answered that. Yes, I meant to mention this too. If you did submit your Signum form and you requested a anonymous message board post, bear with us, because that's a lot all at once, right? So it takes us a little bit of time to get those over onto the message boards and get through those. So hopefully in the next couple of weeks here, we'll be able to get all those over and analyze for you. If I had loans from before vet school and a break where I worked for a nonprofit, can that time be applied to my vet school loans? Yeah. So this is kind of the flip side of that, right? So you could benefit from both of those circumstances. Now, if you haven't documented that public service loan forgiveness progress yet, you would have to submit a public service loan forgiveness employment certification form. And if you documented some public service loan forgiveness time on those loans and then consolidated them with your veterinary school loans, there would be a weighted average public service loan forgiveness credit applied to your veterinary school loans that were included in that consolidation, in addition to the forgiveness count adjustment that you'll benefit from consolidating those loans. Right, now that's some like fourth dimensional student loan stuff, right? So that's again, that's another one where you really need to kind of look at your student loan information to help better tell you what is likely to happen. But yeah, that's a great question. Another one of those reasons why you might consider consolidating. Yeah, so same question there. Both of you guys kind of asked that same question. If you had public service loan for credit on loans from before veterinary school, yeah, make sure that that's documented, right? So upload that student aid data file. And if you do have public service loan forgiveness credit, you're going to see it under this PSLF status tab, right? And if you don't, that means you need to submit that form, right? So if you can document that progress, then you can consolidate those loans with your veterinary school loans. You'll translate some of that credit over to those to that new consolidation loan that includes your veterinary school loans. Can you consolidate a loan that has zero balance? No, unfortunately not. I like the thought though. No. So we have until the end of August to select the plan and consolidate. I actually have not filed my taxes for 2022 because my income was so low. I'm starting a residency this month, and my loans say they are in standard repayment. Yeah, so if your loans say that they're in standard repayment, then they're gonna trigger that standard 10-year plan payment after August. Right, so you can file that tax return, and it'll probably take a few weeks for that to be on file and available. So again, you're kind of getting close. You're bumping up against the timing, crunch that we're all kind of facing here. But it's doable for you to get that in and have that tax return available that you can use to apply for an income-driven plan before the end of August. Do I have to pick a plan at the time of consolidation? If you don't, again, kind of the same thing your loans do if you don't pick a plan after a grace period, it automatically picks one for you. But in the consolidation case, the standard plan is based on how much you consolidate it. And that means most veterinarians are going to eclipse the threshold that's going to throw you into a 30-year fixed repayment plan. And all you have to do is have loans that are greater than, I think it's $30,000, and you're in or maybe it's 60. You have to, either way, right? Nearly every veterinarian has borrowed more than that, right? So it's going to put you in a quote standard 30-year fixed plan if you don't choose one, and that's fine for now, right? But after August, you're going to want your loans to be in a plan that's going to result in a much lower payment based on your income, most likely. I'm a new grad. I want to consolidate, but need time to decide on a plan. That's that's cool. But I mean, I would also, encourage you to maybe, submit that signalment form, and we can walk through that with you on the message boards, and we can help steer you kind of in that right direction, right? So, but again, it's not the worst idea to just let them pick the standard plan for you, but then you'll have to then remember to apply again later, right? And as a new grad, heading into an internship, most likely if you're here, things are going to get really busy really fast, right? So you probably want to take care of this stuff sooner rather than later, before that first payment triggers. Wow, I don't see any more questions in the Q&A.
Great job.
Oh man.
That's like a wildfire around there at the
I
end.
know. And I didn't, again, you do such a great job of asking questions during these things. And we were talking earlier today, my goal was try to keep this under 2 hours, and I failed miserably at that. And we didn't even make it through, I think, a quarter of the slide. So, but that's okay. I mean, all of these things are kind of their own beast, and I'm more than happy to answer you guys' questions than to just go through slides. But just know that there's lots and lots of opportunity and benefit if you choose to dig into your student loans a little bit deeper, and the cost savings are huge. So especially because we have lots of student loans, right? The bigger the numbers, the bigger the savings when it comes to these income-driven plans, particularly in those internship and residency scenarios.
Yeah, and if you're, like we said, we're going to send out a follow-up email with the recording here, as well as the presentation that Tony's been using tonight. And if you have questions that come up as you're reviewing those additional slides or watching the recording here, definitely reach out to us on the student debt message boards. We're happy to discuss these things and dive into it a little bit more.
Absolutely. Thank you, Becca, for moderating, and thanks everybody for registering, attending. And if you have any questions afterwards, you can find us over on the message boards, or we're happy to share all these materials with you too, so you can help make some more sense of all this.
Awesome. Thank you so much, everyone. Thanks, Tony.
All right. Thank you.